Do you want to buy real estate and never stress about money again? Then this long-term investment strategy is just for you. No BS, just results. So right now you're looking at the long-term portfolio. Now this account is a Roth IRA, which is really powerful because in your lifetime you can withdraw up to $10,000 in earnings without paying the 10% withdrawal penalty in retirement accounts. And that's because the government IRS allows you to do this for first time home purchases. So you can take up to $10,000 in gains from your Roth IRA to buy real estate. Now that's a really powerful thing. So when you go to start your long-term portfolio, the way I did it was I used a Roth IRA because I knew that I would be able to take $10,000 out without paying any taxes. Also, any money that you put into the account, you can actually take all your contributions out, okay, without having to worry about any penalties or taxes because they're just your contributions. So the Roth IRA is a really, really powerful, account for home ownership and just saving for your long-term goals. Now, this is a retirement account, so at the age of 59 and a half, you'll actually be able to take all of your gains out tax-free, okay? So not only are you going to be able to save for retirement, have this account grow for you, and all those gains be tax-free, but at the same time, this is a great tool for home ownership. So the brokerage that I use is Charles Schwab. Now, you're going to need to open up a brokerage account and then an account type. Now, we just talked about the Roth IRA. So the reason why I use Charles Schwab is because they directly link with the thinkorswim trading platform, which we have a video out on the channel that you can check out how to use the thinkorswim trading platform, which is the best investing tool to follow the market and invest. Now, there are some other brokerages out there that you can use. The other one that I would use is Fidelity Investments. They're a great company, right? Simple to use. And then another one is Robinhood. Okay, they have a really easy app that you can download. They were the first ones to really come out in the game and make, trading commission zero and just simplify how to invest. So, I use Charles Schwab because it links with the thinkorswim platform, which I really like and I think you should check out. And then Fidelity Investments is another great one, and then Robinhood. But if I had to rank them in order, I would go 1's going to be Charles Schwab, 2 Fidelity, and then 3 Robinhood. I feel as though Robinhood has kind of pivoted, kind of more into gambling. I mean, they started to let people bet on sports and events in their apps. So, I think that can kind of incentivize people to, take risk and, gamble more than they need to. I mean, this video is going over the long-term portfolio. How are we going to save money for, our goals and better our life and, buy real estate and continue to build wealth over time? That's what this video is about. So that's why, I recommend Charles Schwab first, then Fidelity, and then Robinhood. You want to stay away, I repeat, stay away from Webull. Okay, you do not want to put your money in Webull. Okay, now you can do your own research there and explain why, but all I got to tell you is stay away from Webull. Okay, so one thing I wanted to bring up here was the United States savings rate. Now, this is a 10-year chart, okay, on the percentage. How much does the average American save on a percentage basis? Now you can get this data from a website called Trade in Economics. It's a great website. I use this all the time. I highly recommend it. Now, you'll see here, right, for March of 2025, the average savings rate is 3.9%. I mean, that is so low. I mean, out of all the countries in the world, the United States is known to have one of the lowest savings rates out of all the countries. Now, what you have to do is save at a minimum 10%. Every dollar that you touch, save 10%. Okay? So, you're going to have income coming in. You're going to be using your skills. Okay? All the skills that you have learned to generate your income. Every paycheck, every dollar that you get, you have to save 10%. You're going to have to create a budget, break down your income and your expenses, and save 10% at a minimum. A lot of people might say, well, Rob, how am I supposed to save 10%? Well, you're going to have to make sacrifices and figure out your priorities in life, to make these goals come true. A lot of ways I think that people can, cut back on their expenses is, going out on the weekends and drinking a bunch, buying a bunch of drinks, eating out all the time, okay? Those are ways that can just blow up your budget and not be able to make you save 10%. So you have to sit there and really think about, what can I sacrifice? What are my priorities? And that's going to allow you to get ahead in life, and reach these goals. So with the long-term portfolio, we went over, which brokerages here to use. I use Schwab, you have Fidelity, and then you can also use Robinhood, okay? Now, the reason why I bring this topic up is because the average age of first-time home buyers in 2024 was 38 years old. And this trend is starting to increase exponentially. And that is just not right. And it doesn't have to be that way. Everyone listening to this video can own a home, okay? They just have to have a plan set up. And that's exactly what this video is going to help you to do, okay? So we went over the savings rate in America is abysmal. Nobody saves their money. You should be saving at a minimum 10% of every dollar you touch. Okay, that's at a minimum. The average age of homeowners is 38. Okay, we're not going to be doing that. No, that's just not going to happen anymore. Okay, so the goal is we are going to build a long-term portfolio just like this one. Okay, and then buy real estate with it. $10,000 of the gains are going to be tax-free, right, for the down payment on a house. So what I'll do is I'll pull up the calculator here, right? You could buy a $200,000 house that's a duplex, okay? And you can literally live in one side and rent out the other. And the other side could pay for that mortgage payment, okay? Or most of it, so that your housing expense is extremely low. So you could find a $200,000 duplex, okay? And you could go out and get an FHA or a conventional loan. And since it's going to be a primary residence, you'll be able to put down as low as 0 to 5%, okay? So on the high end, let's say we need 5%, okay, for that down payment. That's $10,000 on the down payment, okay? And then there's also going to be some closing costs. We'll call that 5%, okay? As well. So then we'll add another $10,000. So with this $20,000 in this long-term account we have, we could go out and buy a duplex, okay? Live in one side, rent out the other, have no housing expense, live in it for a year, okay? And then go do it again. Because the laws state that you only have to live in that house for a primary residence for a year. And then you could go do this all again. Okay? So now, okay, you know the strategy. So what I wanted to show was that these stocks we're going to buy. You're probably wondering, well, Rob, what stocks do I buy? You have this account in front of me, this Roth IRA, but, I don't know what to buy. And the way the strategy works is you're going to be going out in the market and you're going to be buying individual stocks. And you're going to start with companies that you know and use, okay? you've probably heard the saying before: buy low, sell high. Okay, we're not trying to chase stocks that are super popular and that people are FOMOing over, you know, fear of missing out. They're buying at the highs. The stock's already up 50% on the month. It's hitting all-time highs. Okay, you've probably seen this before. That is the stocks that we are not going to want to chase. We're going to want to, get stocks that are at the lows. Okay, maybe they're at a 5-year low, 2-year low. Okay, we do not want to chase and get FOMO on these names. Okay, so what I'm going to show you here is a watch list that I've created in Thinkorswim with some names, okay, of stocks that I use and know, okay? Because if you can understand the business, when the market goes down and you actually understand what you own, there's less of a chance that you're going to get scared and sell out. And that's the thing you don't want to do. When the market starts selling off and Wall Street's trying to scare you out of your shares, you're going to know what you own. So, for example, I created this watch list, okay, TIUCOC, which basically stands for things I use, okay, and that's what that watch list means, okay? So, for example, Microsoft. I'm recording this right now using Windows software, all right, on my PC, okay? I understand Microsoft. I know it's not going anywhere. Meta. Okay, we all use Instagram. Okay, we understand it. Amazon. I buy things on Amazon and get it delivered to me. Airbnb. I take vacations and I love Airbnb. Google. We all use Chrome as our search engine. Okay, Apple. Everybody has a smartphone. And going down the list, down the list. Uber, right? You ever been at the bars, okay, or something drinking, or you're on vacation? You got to get home. You call an Uber. So and so down the list. Okay. So, you just have to start with names that you know and buy the names that you use. Okay, don't go out there buying some stock that you never even heard of, but maybe you've heard on the internet or someone's promised you that, the company's going to grow 10,000% because they just developed, some crazy innovation. Okay, no, stay away from that stuff. Stay the hell away. Okay? That is not how this strategy is going to work. So that way we can actually, accumulate wealth and buy real estate. Okay? So the key here is to use your income. Okay? Now, you can always grow your income. Okay? Learn new skills, constant learn, continuous improvement. The more valuable the skill, the more you'll be paid. Okay? Then at a minimum, you want to save 10%. The average American you saw here, March 2025, was only saving 3.9%. Okay, and now you're probably asking me, whoa, what are these spikes? How did those go up here to, 25, 32%? Well, what you saw was, in, we'll call it March of 2020, we had, a pandemic, and the federal government stepped in and put a whole bunch of stimulus into the system. They were giving people stimulus checks, just sending people money to go out and buy stuff. So, of course, the amount of money people had skyrocketed. And they were saving them because they were forced to stay at home and they couldn't really go out and spend it. So unless they blew it all online, it was staying in their pockets for the most part. But then you can kind of see here once, the pandemic, was starting to end and the fear subsided, people started to spend their money again. And, you can see the chart going down, down, down. It got to a point as low as 2%. Look here, June of 2022. Every dollar someone made, okay, they were saving 2 cents. That is horrible, okay? You need to save at a minimum 10%, okay? Set up a monthly deposit into the long-term portfolio. Now, a Roth IRA has limits to how much money you can put into it. And the government did that because it's such a powerful tool. Okay, you can take out $10,000 at gains to buy real estate, and when you retire, or let's say just at age 59 and a half, all those gains come out tax-free. So the government kind of gave you this tool to help, but they kind of had to nerf it because it's so powerful. So they nerfed it by putting on a limit to how much you can put in. And that limit is $7,000 a year. So if you want to max the account out, 7,000 divided by 12, okay, that would be $583 a month. So how you would set this up is you'd go into your account and set up a reoccurring monthly deposit of $583. Now, it doesn't have to be this much, okay? You have to figure out with your income and budget, what your 10% is, if it can be this amount, okay? If it's not, that's fine. I don't care if that 10% somehow ends up being $1. Obviously, more the better, okay? But it should not be zero. You have to go out there and apply yourself and make this happen, okay? No excuses, okay? Make sacrifices. Get your priorities straight. Set up your monthly deposits to an amount that you know is reasonable, okay, towards your budget, okay? Now, every month, $583 will hit your account. And you're going to use that cash to buy stocks, individual stocks, okay, in companies that you know. Things I use, okay? They also create another watch list, right? I follow the market a lot, so I know what stocks here are at lows and what are good buys. So for example, coming up soon, we're thinking about adding Pepsi to the long-term portfolio. Okay, so we come down here on this chart, we can pull this out and look at this. We can look at 5 years. Okay, so if you go back 5 years, Pepsi was worth $133. Now it's trading at $131. Okay, the stock was at a high of $196. Now we all know about Pepsi, okay? We've all used Pepsi. We've drank in their products, okay? You've eaten Doritos. You've had Frito-Lay. You've drank in a Pepsi. It's not going anywhere. It's going to be here in 10 years. Do you really think anybody's going to stop drinking Pepsi and eating Doritos? No. So this is a thing we use and that we know will be here in 10 years. Okay, this isn't some name or someone's telling you it's going to explode because they just developed some groundbreaking tech that's going to save us and send us to some planet. Like, come on. That's just not what we're doing out here. So now, once you pick these stocks, okay, the strategy is going to be allocation. Okay, so you're always going to want to own 70% growth stocks and then 30% value stocks. Okay, now growth stocks don't pay a dividend. They don't pay cash out to their shareholders. Okay, growth stocks, their revenue, the amount of money they earn is constantly increasing. Okay, and that's what we want. We want growth. So 70% of the portfolio is going to be growth stocks. And then the other half, or other 30%, is going to be called value stocks. And that's where Pepsi comes in as an example, okay? Because the yield, okay, on Pepsi right now is about 4%. So Pepsi stock, if you were to buy it now, is paying a 4% dividend. So that's why we're also looking at it, because the dividend is 4%. So every year, we're going to be able to get 4% just for owning the stock. And then eventually it's going to rebound because right now it's getting hit because of this tariff news because of Donald Trump. Okay? And the stock's off because of tariffs, but we know the company will be here in 10 years. I mean, let me tell you, I love Doritos. I'm not going to stop eating them. 10 years from now, I'm going to be eating Cool Ranch Doritos, okay? So it's going to be here. All right? So now, this is the strategy. Okay? Income, save, invest. Use our plan. Open up a Roth IRA. Make monthly deposits. Okay? Buy individual stocks that you know and use. Buy names that are at lows, not highs. Okay? You're going to have to open up a brokerage account. I recommend Charles Schwab, so that way you can link it with your Thinkorswim platform that I was just showing. Okay? If not that, use Fidelity. It's another great easy one. Okay? And then if you want it really simple, you can download Robinhood, which is an app on your phone too. You just have to make sure that you don't get dragged in to the hooks they try to do, and you start gambling on, will the sky be blue tomorrow? Okay? So we're not trying to do that. So, I'm out here trying to help people save more, understand how to do it. Okay? Not only save like down here 2% of your money. Okay? And then also change this dynamic of the average age of first-time homebuyers in 2024 was 38 years old. No. Okay? Get the long-term portfolio, save 10%, okay? Buy individual stocks at lows that you know will be here in 10 years, that you are familiar with, and you hold them, okay? Now that is how you are going to accomplish your goals and build wealth.